Speaker Pelosi goes to Taiwan. OPEC goes small in response to President Biden's plea for more oil. And central banks, they go big in the struggle to tame inflation. This is Bloomberg Wall Street Week. I'm David Weston. This week, contributors Larry Summers of Harvard on higher rates and lower employment, and Steve Rattner of Willett Advisors on what the Inflation Reduction Act could mean for Wall Street.
So I think this is good for investors in that it brings, again, some stability to fiscal policy in Washington.
It was a week full of signaling as Speaker of the House Nancy Pelosi went to Taiwan to send a signal to China about U.S. commitments.
Today, our delegation, which I'm very proud, came to Taiwan to make unequivocally clear we will not abandon our commitment to Taiwan, and we were proud of our enduring friendship.
While China sent back its own signal of displeasure with the visit.
We will do what we say, and let me say that these measures will be firm, strong, and effective.
And OPEC Plus responded to President Biden's request for more production by increasing its limits, but by a very modest 100,000 barrels a day, which Amos Hochstein of the State Department said was nice, but not enough.
The importance that the president has is not discussing barrels with any country. He has been very clear that he wants to see oil prices come down, and he wants to see gasoline prices come down.
But it wasn't just geopolitics this week. We also spent a fair amount of time getting signals from our central banks, whether it was the Bank of England on Thursday raising rates 50 basis points as they battled even higher inflation.
CPI inflation is now expected to peak at just over 13% in Q4 of this year, and to remain at very elevated levels throughout much of 2023.
Or various Fed members all week long trying to walk back Chair Powell's statement from last week that we were close to the neutral rate.
We are a long way away from achieving an economy that is back at 2% inflation, and that's where we need to get to.
And then came Friday, and boy, did we get a signal with jobs numbers coming in twice what was expected, a full 528,000 people. And June was revised up as well, with wages increasing at an annual pace of 5.2%. Not surprisingly, this gave the bond market yet another abrupt turn, and the 10-year yield, which had dropped to near 2.5% earlier in the week, shot up again to end the week at 2.83%. And while equities were volatile, they weren't as bad as bonds, with the S&P 500 ending the week up just over 1/3%, while the NASDAQ moved back toward bull territory, at least for a time, ending the week up over 2%. Here to help us sort through yet another challenging week for the economy and for the markets, we welcome Mona Mahajan. She is Chief Investment Strategist at Edward Jones and Senior Markets Editor for Bloomberg, Authers. So welcome both of you to Wall Street. Good to have you here. Mona, let's start with you. And certainly those jobs numbers really got our attention on Friday. Were really dominant. What did they tell the markets?
Yeah, look, David, it's hard to really say that we're in a recessionary environment with jobs increasing over 500,000 this month. Now, keep in mind, the U.S. economy has started here from a position of strength. So while we could see weakening in the jobs figures, in earnings data in the months ahead, we certainly are nowhere near what we'd call an economic downturn or recessionary environment. Now, what were the market implications of this move? Well, you touched on some of them, but one thing we saw right off the bat, the expectations of a 75 basis point Fed rate hike really skyrocketed between yesterday and today. Yesterday's probability, 35%. Today, we have a 65% probability of a 75 basis point rate hike again by the Federal Reserve in September. The second thing we saw was, of course, those yields. So Treasury yields, both on the 10-year and the 2-year. Now, keep in mind, the 2-year tends to be a proxy of what the Fed may do in the next couple of years or so. Both skyrocketed higher. But we continue to have what we call an inverted yield curve. So historically, this inverted yield curve does provide a leading indicator of a recessionary environment, but there is some lag to it, 6 to 18 months. So net, we saw a market that absorbed this higher jobs figure, absorbed a potentially more aggressive Fed. But what we did see under the surface was that some of those growth parts of the market, longer duration, tech, speculative, higher valuation parts of the market, did underperform again today. And that might be a theme we see going forward as well.
So, John Authers, you follow central banks all around the world all the time, including the Federal Reserve. Did the Friday numbers make the Fed's already difficult job harder, or did it make it easier?
I think it made it easier. They are people. I don't think myself that Powell tried to be that dovish last week. I think he meant to give the impression that he was still very much committed to a more hawkish series of rate hikes. He was open to the claim that he was just not credible for a while. The number of people who are convinced that the Fed will have to turn around swiftly because the economy will be too weak has been strong. That's been why we've had this really remarkable fall back down in yields. And with numbers like that, it's very hard to criticize them for tightening rates. There's obviously the employment picture could scarcely be stronger. There is really no good practical reason why they shouldn't be very aggressive in raising rates to cut inflation. So I think their job has been made simpler. I don't quite understand why the stock market is still very calm about this and still plainly in the middle of quite a strong bear market rally. That does surprise me. I thought the numbers we got today would have been enough to shake the stock market far more than it did.
Yeah, I want to come back to that. But first, Mona, let me ask you, do you think it's possible for us to have this kind of job growth and still get inflation under control? Or do we have to see a change in the employment situation?
Yeah, clearly we have to differentiate between headline and core CPI here and inflation expectations. So, of course, the headline number will be driven by what we see in energy and commodity markets. And we've been seeing a nice move lower really since the beginning of July, mid-June. We've seen oil, but not only oil, food, grain, industrial metals, all roll over to some extent, probably driven by concerns about global demand rolling over as well. On the core side, we're continuing to look at what we call shelter and rent inflation, but also services inflation. Both of those are stickier than we'd probably like to see, but the Fed has to continue to put pressure on the core part of the market, and keep in mind their preferred metric is core PCE, in order for them to meet this mandate. Now, what else we're watching, and the other good part of this story, is that we are starting to see inflation expectations and break-even inflation rates starting to come down from their highs as well. So inflation hasn't yet been anchored permanently higher, at least in the minds of consumers, which is something the Fed does watch. So in our view, we do think inflation will start to moderate, certainly on the headline side and also on the core side by year end. And we should start to see, even things like shelter and rent be impacted lower by inflation sensitive parts of the market, interest rate sensitive parts of the market, like housing, for example, but even ultimately like durable goods and services as well. Well,
that's the key question, isn't it? Some of those more durable factors in inflation. Yeah. John, what about that? We're going to get CPI numbers next week, and you have things like owner rent equivalents and things like that.
Yeah, I would be surprised if we don't see some kind of a decline, simply because in the year-on-year rates compared to last month, because gas prices really have come down very sharply from an extreme level. So the chances that we see a decline in the headline rate are fairly high. That's politically quite important. It doesn't really help the Fed that much at all. I think Mona's completely right to stress the rent issue. The problem with rent is that because of the way it's calculated, which we don't need to go into now, it tends to have a lag, and the likelihood is pretty strong that we've got quite a few more months of increases in rental inflation already baked in. And there is, again, this is one area where monetary policy will work. You make it more expensive to borrow to buy a house, and demand for houses will go down. You will see, I think, the Fed feeling obliged to keep hiking to control that area of the inflation. The other important point I want to make, though, is people get excited about whether the peak is in, understandably, but what really matters is how quickly it comes down. There's a very big difference between core inflation being back down to 3% by the end of this year, or it's still being at 5%, even though both would represent a decline. it needs to come down pretty fast. And if it doesn't come down very fast because of this concern about creating new baked-in inflation expectations, the Fed is going to have to be more aggressive than people are currently pricing.
Well, Mona, what about that? How fast do you expect it to come down, if in fact it does come down? And let me put one more thing in that there may be momentum behind, and that is salaries. The salaries went up 5.2% year over year in the numbers we got this week. At the same time, it's thought that they're kind of sticking. There are a lot of people out there that are just waiting for the next raise and are going to expect something pretty big.
Yeah, absolutely. Look, I think the inflation rate we'll start to see, and to John's point, the year-on-year comparisons, and based on those base effects alone, we should see headline numbers start to move towards 6.5%. But will we reach that 2-3%? Probably not till at least mid-end 2023. But that could be driven by exactly to what John was talking about as well. That lag effect from a weakening housing market, potentially a softening labor market, and potentially just weaker demand globally. That should all put downward pressure on inflation and that core part of the inflation, which does take some time. And when we looked historically, takes about 2 years for inflation when it's above 5% to go from peak to trough. So if we did peak, last month, we may not reach trough until another 12 to 24 months from now. But if the direction of travel is in the right way, we could start to see the Fed at least take a pause at some point next year and assess the situation, assess the economy as well.
John, what about wages? Because we got those very strong employment numbers out. There was sort of a head fake, I thought, in some of the JOLTS numbers and the unemployment claims. What is going on? Are we seeing real softening in the labor market?
It's a very difficult one, isn't it? My best guess, because I, like everybody else, was surprised by today's numbers. The JOLTS number, I suspect, has come down simply because companies are beginning to fill those vacancies. I'm not sure that it's because they are already drawing in their horns and taking job ads down without ever having filled them, which was a popular explanation earlier in the week. But the bottom line plainly is that there's, I suppose with the claims, the notion there, although it's not fully borne out by the establishment survey either, is that more people are looking, that more people are trying now to get back into the labour force, and things are therefore showing up as more people claiming unemployment insurance, even though the overall numbers show a strong market. The wage inflation, you mentioned earlier on Andrew Bailey of the Bank of England. He got into a lot of political trouble for urging people not to ask for more, for higher pay, which he certainly would like it if people didn't get better pay rises. But it's utterly reasonable in times of high inflation to want a higher pay rise. Yeah. It's a very difficult issue.
Yeah, good luck with asking people to ask for lower pay. I've never had much luck with that. Thank you so much to John Authers of Bloomberg and Mona Mahajan of Edward Jones. They're going to be staying with us as we took a look at what else may be driving the markets, particularly in geopolitics, and where those markets may be headed. That's coming up next on Wall Street Week on Bloomberg.
This week, China did some saber-rattling versus the U.S. Where does China fit in your thought process in the future? Are there any significant investment implications with what's going on in China?
Well, in my group, I think that China is the biggest potential growth vehicle for Boeing. 2 years ago, Boeing delivered about 16% of their total aircraft output went to China. It slipped down a little bit the last 2 years, but we anticipate, say, as we get back to the turn of the century, it could go 16 to 20%.
That was Michael Holland and Peter Esseritis on Wall Street Week back in 1996. And once again this week, China was in the news with Speaker Pelosi's controversial trip to Taiwan and China's rather strong reaction, which certainly caused a geopolitical stir. But did it have any effects on the markets or potential effects on the global economy? Here to help us answer those questions and more are Mona Mahajan of Edward Jones and Bloomberg's Senior Markets Editor, John Authers. So, John, you actually wrote a column earlier this week noting the bond market reaction, apparently in part to Nancy Pelosi's visit. But do you think it has longer-term ramifications?
I fear it has very much greater longer-term ramifications, and I'm a little concerned both how quickly the bond market got worried. We had a brief period of not much more than 24 hours when there was really quite intense demand for treasuries, born on the classic desire for a safe haven, and more or less as soon as Nancy Pelosi's plane had landed in Taiwan without the Chinese trying to shoot it down, I'm only slightly exaggerating, the market rebounded as though everything was okay. And certainly the degree of saber rattling we're seeing at present from China is quite concerning. It's conceivable that this speaker's trip has in some way called China's bluff. I'm not a military strategist, but plenty of people are pointing out that Taiwan is an island 100 miles away from China. It will make Russia couldn't make a good job of invading Ukraine. China actively invading Taiwan is going to be orders of magnitude harder. So whether arguably the risk of a total breakdown, a return to conflict is still quite slim. But there's no question. If this leads to a serious worsening in US-Chinese relations from where they are now, or, which we must all hope not, outright conflict, that's very serious. That's any way you look at it, that's going to be bad.
Mona, what about your perspective? And not just limited to China. We have an awful lot of geopolitics going on, as John just referred to briefly in various respects. Do you think geopolitics is affecting the markets right now, or do they have enough to worry about, whether it's inflation or whether it's supply chains or whether it's the Fed?
Yeah, David, this year we actually got an outsized amount of geopolitics impacting markets directly, of course, starting with that Russia-Ukraine conflict, which not only kind of exacerbated the inflationary problems, but really put upward pressure on oil, energy, grain prices across the globe. And then, of course, we did shift some focus to China, but because of the lockdowns and the on and off lockdowns created tensions in supply chain, created some demand reopening and then shutting down once again. And then, of course, with Nancy Pelosi's trip this week, we started to think about maybe another tail risk emerging in geopolitics, which is the China-Taiwan situation, which could potentially, at least in an investor's mind, could be a Russia-Ukraine 2.0. And keep in mind, the implications would be quite a bit more severe. Supply chains and inflationary pressures, again, could be exacerbated to even more extreme level. So for now, in our view, we think it's a tail risk, but certainly one that's worth monitoring, and certainly one that we're watching could intensify in headlines if we see, another similar type of trip, negotiation, discussion. But hopefully for now, a tail risk that has a lower probability than certainly what we saw in Russia and Ukraine.
So Mona, translate it into some investment advice, if you would here. Does that mean if I'm an investor for my portfolio, I should look at more defensive investments, whether that's equities or debt? Stay away from growth right now?
Yeah, I think in the near term, so look, we've had a great run, rebound off the lows of mid-June across equity markets and even in fixed income. So in equities, we've seen the S&P rally nearly 13%. Underneath the surface, the growth parts of the market, technology, et cetera, are up nearly 20%. Similarly, fixed income rebounded off lows as well. Now, going forward, if we start to see yields move higher, we've had a really nice move downward in yields, but keep in mind, we still have the Fed in play. We still have quantitative tightening in play, which could put upward pressure in yields. If that occurs, we could probably once again see growth start to underperform or lag again. So in our view, as we get through the next few months, as those earnings and economic data perhaps start to soften, catch up with what we've seen in equity markets earlier this year, we would advise a more defensive tilt, value-oriented defensive sectors in equities and fixed income. But if and when we do get inflation kind of in earnest moving lower, the Fed in earnest able to pause, that's really when we see a pickup in risk assets, but perhaps a shift towards growth once again. And that's when you'd start layering in and barbelling growth. But for now, we'd say stay invested, stay perhaps somewhat defensive in the months ahead. But don't be surprised if earnings and economics bottom. Start to bottom, but equities look forward and start to move higher. So that's what we do expect to happen, a U-shaped recovery ahead.
So John, just overly simplistic here, briefly, does that mean I should have more bonds than I thought I should?
That is a very difficult one. I tend to be somewhat bearish on bonds. I think that there is a risk that the peak for the 10-year rate isn't in yet, and that means that you probably don't want to pile too heavily into bonds. My best guess, because all of us have to contend with the fact that we don't really know the lack of good precedents for what happened to the world in 2020 means that there is also a lack of good precedents for what we should be expecting now. My best guess is that rates probably have to rise higher to choke off inflation. The rule of thumb is that inflation doesn't go down, doesn't peak until the interest rate exceeds the inflation rate. That implies that we're going to be going, I would say, above 4% at least. And that would mean that you would want to be getting into more defensive kinds of stocks that actually benefit from higher rates, which, as Mona said, is basically value. If you wanted, in terms of tail risk, there's this Machiavellian possibility of getting into chip makers that aren't from Taiwan. If something bad happens there, then there you can suddenly be a lot more scarcity of chips.
Yeah, there you go. There's an interesting investment tip. Chip makers that are not in Taiwan. Thank you so much to Mona Mahajan of Edward Jones and Bloomberg's own John Authers. Still ahead, we're going to take a look at what's happening next week on global markets. That's coming up next, right here on Wall Street Week, and we are on Bloomberg. This is Wall Street Week. I'm David Weston. It's time now to take a look at what's coming up next week, starting with Juliet Sally in Singapore.
Thanks, David. The monthly China data dump will be crucial for investors trying to navigate signs of a recovery, but there is plenty more to keep an eye on in the region, with the Bank of Thailand poised for liftoff, GDP from the Philippines and Malaysia, as well as an inflation print from India after the RBI last week brought rates back to pre-pandemic levels. And Japan's producer price inflation likely slowed to 7.7% year on year in July.
In the coming week, we'll get the second quarter GDP data out of the UK, which should provide some clarity on the impact of Britain's cost of living crisis on economic growth. We'll also get the latest inflation readings and updates from Greece, Lithuania and Latvia on Monday, Hungary on Tuesday, Denmark and Germany on Wednesday, and France on Friday. Also on Friday, we get an advance reading of Russian GDP for the second quarter, so we'll see just how much Western sanctions are biting.
Thank you, Lizzie. Of course, here in the U.S., a lot to look forward to next week. Coming off of a big Jobs Day report, how do we think about a CPI and a PPI print starting to come next Wednesday? PPI, a lot of economists with CPI as well, looking for it to decline from peak of 9.1%, maybe down to about 8.8%. But as we know, still well ahead of a 2% level from the Federal Reserve's target. We want to pivot to earnings as well. When you think about a big one to watch, Disney coming on Wednesday as well. How do you think about subscribers for the classic Disney Plus streaming service that they have, all in the face of Netflix as well, and some of the reported slowdowns over there? And of course, Coinbase with the big rout in crypto. How does that crypto exchange and trading platform fare amidst all of this volatility? Back to you, David.
Thanks to Juliet Sally, Lizzie Burden, and Taylor Riggs. Coming up, Democrats like their new reconciliation package. They call it the Inflation Reduction Act. And some economists, well, they like it too. But what would it mean for investors? We ask Steve Rattner of Willett Advisors. That's next on Wall Street Week on Bloomberg.
Well, this is really a very comprehensive and historic piece of legislation.
Joe Manchin, he made a terrible deal.
Leave it to Congress to surprise us. Take two of our biggest problems, inflation.
We have a serious inflation challenge, which is hitting economies around the globe.
And climate.
As the climate crisis gets worse, extreme weather will pose a rapidly growing danger to a rapidly growing number of communities.
put them together in one big package and give it the attractive name of the Inflation Reduction Act.
This bill will reduce inflationary pressures on the economy.
In the end, it all came down to getting West Virginia Senator Joe Manchin to sign on.
This is fighting inflation. This is all about the absolute horrible position that people are in now because of the inflation cost.
And Senator Manchin's Republican colleagues, like Pat Toomey of Pennsylvania, can't believe he went along.
It's a very significant corporate tax increase, mostly focused on manufacturers, which is a bad idea. It's combined with price controls on prescription drugs. I've been asking myself, what does Joe Manchin get out of this?
But thus far, economists like Larry Summers think the Inflation Reduction Act may be just what the doctor ordered.
I was glad to see the bill. I think it's going to reduce the rate of inflation because it's going to reduce deficits and demand over time, because it's going to use the federal government's power to negotiate lower prices for pharmaceuticals, and because it's going to increase supply of energy.
So economists really like the Inflation Reduction Act, but what does it mean for investors? To get an answer to that, we're going to turn to someone who invests a fair amount of capital. He is Stephen Rattner. He's chairman and CEO of Willett Advisors. They invest the personal and philanthropic assets of Michael R. Bloomberg, who, of course, is our founder and majority shareholder. Steve, thanks so much for being back on Wall Street Week.
Of course, love to be here.
So you wrote a terrific op-ed piece for the New York Times this week, in which you said, and these are pretty strong words, I must say, you think that this may be one of the best packages that you can remember Congress giving birth to. So you think this is a good idea for the country. What does it mean for investors?
I think for investors, it's basically positive. I think we're making progress on a number of our really important problems, climate being first and foremost among them. That's good for the country. It's ultimately good for investors. I think prescription drugs pricing may not be absolutely great for every pharma company in America, but for the average American, it will eventually give them more spending power and therefore the ability to buy other things, and that helps the economy. The minimum corporate tax is just something we needed to do. I think the Trump TCJA was so wildly unfair in terms of the amount of the business rollbacks that this brought it back. I would note that after the Manchin proposal was very surprisingly announced, as you know, nobody thought this was coming, but after it was announced, the stock market in the next several days had several of its best days throughout the difficult period. So obviously investors were not put off by this thing, and indeed even encouraged by the idea of progress in Washington.
One of the things Republicans have picked on, for example, Pat Toomey from Pennsylvania, is to say that corporate minimum tax effectively would take some of the benefits away from the expensing of capital investment, will deter capital investment by corporations, ultimately hurt us in terms of investment and in terms of growth.
Well, the first part of that is right. We are taking some incentives away. Although we're doing it, we're not really directly taking them away. We didn't roll back the depreciation provision. We simply put a minimum tax on all the corporate profits. So that, in fact, leaves most of the investment incentive in place. But there are those of us who felt that that was simply too much when it was passed in the TCJA. Why give companies 100% write-off up front? Is that really going to change investment that much? Is it really the way you want to run tax policy? And I don't think there's a lot of evidence that had much of an impact on investment. So I don't buy that. I think the problem of investment here is there are not enough profitable opportunities out there, not that companies are worried about their tax rate or they don't have the cash or something like that.
One of the aspects of this, obviously, is the inflation reduction because, as I understand it, of reducing the deficit, actually paying for it, having more in revenue than the costs going out. What does that do to investors?
Well, first, on the inflation thing, the Republicans have created, I think, a false dichotomy in a way. They've made the point or claimed this wouldn't really reduce inflation. And that's not untrue. Its impact on inflation in the first few years is relatively small, gets a bit larger in the out years. But the most important thing is that it is a reversal of policy from the last several packages we've passed that have been highly inflationary. So I think this is good for investors in that it brings again some stability to fiscal policy in Washington. For the first time in a long time, a fiscal policy package that actually does at least lean against inflation, even if the total impact isn't enormous.
If this package, and again, we're assuming for the moment that it gets enacted, if it in fact gets enacted, is the benefit to investors mainly sort of the rising tide notion? I mean, it's the macro that everything goes up and so we're all better off, or are there specific sectors that actually would be more attractive to investors, such as you mentioned, climate and energy?
But yes, the rising tide is certainly the overarching part of this. It's not a complicated package. It doesn't have that many provisions in it. So it really is climate and prescription drugs, and then obviously some of the tax stuff. So in climate, I don't think anyone yet has really been able to comb through all the little minutia in this bill, but in the climate section, you have to believe there will be opportunities for investors and also warning signs for investors about where not to invest as we go through this energy transition. And then we'll have to get a better understanding on the pharma side of what the impact is on that sector. But that's a long phased-in program over, I think, 7 or 8 years. And so, again, no immediate impact.
You manage investments around the world, not just in the United States. One of the key questions we always ask is, what does this do to the competitiveness of the United States versus other regions, whether it's China, Europe, wherever? Does this make the United States more competitive in success?
I'm not sure the difference is that great. I think that this is an important bill for the reasons that I wrote in my piece and the reasons I believe. But I'm not going to sit here and pretend it's going to transform everything. I think with respect to climate, for example, it simply gets us closer to meeting the Paris Accord. Look, we have to understand that addressing the climate problem costs us money. People who say, well, you can kind of make this a profit center, it's not a profit center, it's a cost center. It's something, it's an externality, as economists would say, a byproduct of our having been irresponsible for many years, and now we're going to pay the price of cleaning it up. So I would not pretend it makes us more competitive. I would say that it gets us more in line with some of our partners, particularly in Europe, who've done more on climate than we have, and it's time for us to do our share.
Is addressing the climate situation inherently inflationary?
Inherently, there's a cost to it. Look, I believe, and I'm sure some economists have studied this, but if you go back to the early 70s when we had a huge environmental problem, and you and I are old enough to remember when the Cuyahoga River went on fire, and that sort of galvanized people to do something, part of, I think, why our economy struggled in those years was because we were paying a huge cost to clean up environmental problems all over this country that were cost but not revenues, cost but not profits, cost but not really benefits beyond having a better environment. And I don't think this is as big a deal as that, but this is in the same direction. There is a cost to addressing climate, and we shouldn't pretend it's otherwise.
It's part of a larger pattern that we're addressing right now of inflation. And just while I have you, let's talk about that issue as an investor. Because there's a back and forth. Is the Fed going to go too far? Are they not going to go far enough? The markets are reacting, perhaps overreacting to some of the hints we're seeing right now. How does the Fed raising rates affect you? I mean, are you happy with them raising rates? Do you want them to do more, less? What's best for you as an investor, a long-term investor, I should say?
Sure. Well, look, first of all, markets are not always right. And as we sit here today, markets are assuming a path for the Fed and a path for the economy that many of us feel is completely unrealistic. And if anything, the markets have gotten more optimistic about how far the Fed will have to go, when rates will come down over the last several weeks. You've seen the 10-year come down. You've seen the 5-year forwards. All the indicators are that the markets have become, I think, irrationally optimistic about what the Fed is going to have to do. High rates are the enemy of the stock market. There is no getting around it. It is the alternative use of capital. It's the so-called risk premium. You know all that. And so I have been fairly bearish on the market because rates have to go up. And I would continue to take that posture. I think rates are going to have to continue to go up very substantially. I think we have a kind of embedded core rate of inflation, if you will, of between 4% and 5% in this economy. So it's not 9%, but it's still so far above the Fed's 2%. They're going to have to do a lot of work to get it back there.
Thank you so much. So Stephen Rattner, he's the chairman and CEO of Willett Advisors.
My pleasure. Thank you.
Coming up, we wrap up the week once again with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. We end the week, as we always do, with our special contributor, Larry Summers of Harvard. So, Larry, thank you so much for joining us. Let's address that big number that came out on Friday, 528,000 new jobs. Also, revision up in June. And by the way, wages up at a rate of 5.2% year over year. President Biden came out and said this shows that his economic policy is working. What did you make of those numbers?
I think it's more mixed. I celebrate all the extra jobs, and that's surely a good thing to see, but my principal concern, as you know, David, has been that we've got an overheated economy, and that if you overheat the economy longer and longer, you get more and more inflation and bigger problems down the road. And everything in this number says to me, overheating, not yet under control, not on a path to being under control. So I was actually not gratified by these numbers, but my concern was actually magnified.
So what message does this send to the Fed, do you think?
Look, I don't think the Fed has the thread right now. As I said on this show last week, I think the idea that we're at the neutral rate or near the neutral rate is not a defensible concept. And now when we're seeing wage inflation unambiguously after this number accelerating, after this number, after the ECI, after the Atlanta Fed, we have, by every reasonable measure of core inflation, inflation running somewhere plus or minus 5%. That is more than it was when Richard Nixon put price controls in place. That is not acceptable by any dimension. And if we don't act on it and act strongly on it, and that means raising real interest rates significantly, then we're just setting the stage for stagflation. Here's what I'm very worried about, because we've seen the movie before. I'm worried, and I was interested to see that Paul Krugman, who's hardly agreed with me in general on these things, expressed exactly this concern today. I'm worried that we're going to see some good news on non-core inflation, on commodities, on what's happened in gasoline, for example, and we're going to see a bit of economic slowing, and that's going to lead the Fed to think that things are under control. But in fact, underlying inflation is going to be still completely unacceptable. Things are going to go up and down in terms of the non-core inflation. And if we've got a labor market that's red hot, that's only going to mean constant or even accelerating inflation. And we're going to have a situation like we did in the 1970s, where we perpetuated inflation by not doing enough to contain it. The doctor tells you to take all your medicine. If you take only some of your medicine, you're going to get the illness back. The bacteria are going to be resistant, and it is going to be worse. And that is the risk that I believe we are running in this situation, on the path that the Fed is predicting and on the path that the market is expecting.
Another big piece of news this week came from that Inflation Reduction Act, which you talked about last week on the program, saying you were glad to see the bill. It's been adjusted in some ways to accommodate particularly Senator Sinema from Arizona. But as of right now, it looks like it may well pass the Senate this weekend and maybe be enacted next week. So what do you make of the bill as it looks now, the package as much as we understand it?
This is really positive news. This is good news on health care. This is good news on the environment and energy. This is good news on tax reform. This is going to make our economy better, while at the same time reducing the budget deficit and contributing, albeit in a small way, to a reduction in inflation. But it is a beginning, a very important beginning, not an end. We still have huge international tax loopholes that are driving businesses abroad. We still, shockingly, and this is something that really disappointed me, and I was sorry with the judgment that Senator Sinema came to, we still have the carried interest loophole that is allowing many of the wealthiest Americans to pay taxes at a much lower rate than the people who clean their floors by getting capital gains on what is really earned income. And it is just wrong, and it makes me worry about our politics that it has lasted as long as it has. But look, that's for another day. For today, it's to celebrate that this is a good and important bill that is moving the country forward. And I think it's a tribute to the perseverance of many, the perseverance in negotiating and negotiating and negotiating of Senator Schumer, of Senator Manchin, who many people have raised questions about and who I don't agree about on everything, but who has stuck with some basic views he had about the importance of not adding to inflation for a year, and contrary to what many people said, was prepared to reach a deal if it was the right deal and stayed at the table. And above all, I think it reflects the fact that President Biden laid out an agenda, pointed to things that he thought were very important, recognized that not everything he started with was going to happen, but that some things needed to happen. And for him, for Secretary Yellen, for Chief of Staff Klain, for NEC Director Brian Deese, who played a big role in all of this, I think this is a very substantial victory. And the fact that it took a long time coming shouldn't blind anybody to the fact that it's something very important.
Larry addressed one specific issue that's come up in the scoring, as it's called. The Joint Committee on Taxation, which is bipartisan, came out and said that, in fact, a fair amount of the tax burden would fall on people who make $400,000 and less. And I understand what that is. It's saying if the corporations are paying more tax, some of that is going to go to the employees and the regular consumers. What do you make of that argument? Is it true?
I don't think it's very good economics. I think that the corporate share owners and other capitalists pay the vast majority of corporate taxes in general. And I think that's even more true with respect to corporate subsidies and loopholes. And it's corporate subsidies and loopholes that we're going after as a consequence of this. I think the vast majority of Americans are happy to see the tax rate on companies like Amazon go up, and they're not worried that that means an increase in their taxes. They'd much rather see us, when we need tax revenue, as we do now, go after companies that year after year after year are reporting billions of dollars of profits to their shareholders and still not paying taxes at a rate of even 15%. And that is all that this bill goes after. High profits to shareholders, no taxes. That's the right thing to do.
So finally, and briefly, if we can, Larry, tell me, does it change your view about whether Washington works? Because if you look at actually what this Congress has done, some of it bipartisan, some of it not, it's gotten an awful lot done with a 50-50 Senate and a narrow majority in the House, and a fair amount of it bipartisan, like the infrastructure bill, like the CHIPS Act.
I think it does. David, I've said it on your show before. The great thing about America is its resilience, its capacity for self-denying prophecy. Everybody predicts that our system is going to collapse, that nothing's going to work, that we're not going to be able to do anything, that we're not going to meet our challenges. And that generates sufficient alarm that ultimately we do step up. Now, we've got a long way to go, but I feel better about the fiscal side of what our country is doing today than I did a week ago or a month ago or, frankly, a year ago. And I think that that's something that all of us should take some satisfaction from.
I'm not sure everybody is, though. Is there a communications failure?
Look, I think when you have a process that's as messy as this one, when you have as much transparency as today's news stories filed every 2 hours, social media, tweets, it's just hard, you know. Great surgeons accomplish remarkable things, but if people had to see the surgery, it would all feel pretty grim and awful. And it's a bit like that with legislation like this. So I'm not sure we are there, and I'm not sure we will get there. But I think that ultimately it's going to be the results that matter. And we're going to have less climate change. We're going to have America more as a process. Millions of people who were worried about their bills for health care now have them assured, and people are going to go to the drugstore and they're going to get lower prices. And I think ultimately it's results, not process, that matter.
Larry, thank you so very much. Our special contributor here at Wall Street is Larry Summers of Harvard. Coming up, there may be great actors or athletes, but should we be getting our investment advice from them? That's next, and it's on Wall Street Week on Bloomberg. Finally, one more thought. All that glitters is not gold, but it might just be crypto. Remember those glory days of yesteryear, or at least the year before last, when money was cheap, the Fed was still cutting rates.
Today, the FOMC kept interest rates near zero.
And asset values had nowhere to go but up.
We're near record highs. The stock market's making brand new record highs.
Equities can continue to move higher.
One of the hottest asset classes of the last few years was crypto, with Bitcoin peaking near $70,000 just after Mr. Powell announced his decision to cut rates again, making it just too good to resist for investors like Michael Saylor.
We have to invest in something, and we've chosen as a business strategy to focus on what we believe is the most exciting investment idea, because it's a digital commodity that's absolutely scarce and only getting technically better every year.
While Mike Novogratz told our own Eric Schatzker it was as good as gold.
It's a weapon in people's portfolio. It is a version of gold. We call it digital gold.
And if retail investors needed any more reason to get on the crypto bandwagon, they got a not-so-subtle nudge from some of the biggest celebrities around. People like greatest of all-time quarterback Tom Brady.
I'm getting into crypto with FTX. You in?
And Reese Witherspoon tweeting, quote, "Crypto is here to stay." And Steph Curry telling us he's not an expert, but that's not stopping him from trading crypto anyway.
This is Steph Curry, the world's leading expert on cryptocurrency.
I'm not. But that was then, and this is now. Inflation is up.
We really need to restore price stability, get inflation back down to 2%.
The Fed is on a tightening spree.
Well, the message is that there will be continuing rate increases, although I think starting at the September meeting, as he said, it will be meeting by meeting.
And crypto isn't looking like quite the sure thing it did to some, with Bitcoin down over 60% from its peak, leading people like Eddie Lowe of Maybank Singapore to lose faith.
Crypto was actually touted as the alternative gold when Bitcoin was at 60,000. But I think now at 20,000 or below that, it's no longer really that valid.
And that's even before we get to questions about what mining crypto is doing to our climate.
Bitcoin community should see the biggest risk to Bitcoin is climate is getting worse. We see it in the news every day, and Bitcoin is contributing to that.
But never fear, Matt Damon is here. And we know that the characters he plays in the movies are nothing if not courageous.
We can't stay there, it's not safe.
But Damon also styles himself as brave, at least according to this Crypto.com ad.
4 simple words that have been whispered by the intrepid since the time of the Romans. Fortune favors the brave.
I suspect that there just may be some crypto owners out there hoping that fortune catches up with Mr. Damon's bravery. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.